The fact that he opened the door to a September rate cut is really what created the last moves in gold, and it found resistance at 2,500. Anytime any stock or commodity goes to an all-time record high, it typically meets resistance, and that's what we're seeing with gold. Gold does find support either at current pricing, right at around 2,400, or a little deeper to 2,375. It would move at least equivalent to what we saw during what we're labeling as the first part of this rally, or wave one. In other words, from 24, we would move back to about 25.80 or 88. A really bullish rally would take it to 26, and as high as just shy of 2,700.
Money managers' wagers in gold jumped to the highest level in 4 years, signaling investor concerns surrounding the U.S. presidential election campaign, as well as a renewed focus on the timing of Federal Reserve interest rate cuts. Hedge funds and other large speculators boosted their net long position in gold, often used as a hedge against rising political and economic uncertainty, to the highest in more than 4 years as of July 16th. Weekly U.S. government data published Friday showed. GaryWagner, a seasoned technical analyst renowned for his insights into financial markets, delves into the recent correction in gold prices. While discussing gold's recent price surge, Wagner attributes it to the ongoing global fiscal deficits and monetary policies. He highlights how increasing debt burdens and currency devaluation pressures, particularly on the dollar, have significantly bolstered gold's appeal as a safe haven asset. The only definitive assertion that can be said about the relationship between gold and the dollar is that the dollar has lost over 98% of its value relative to gold since 1971. Since 2008, the global demand for physical gold, particularly from Eastern Hemisphere central banks and investors, has had a more substantial influence on determining the price of gold than the movement in the US dollar over the same period. Furthermore, Wagner mentions a corrective phase in his recent analysis of gold price movements. According to his long-term Elliott wave model, gold could resume its bullish trend and rally higher in the coming months. Now we present the clips of GaryWagner's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
What we're using here is the combination I just spoke of. What I find most interesting is that this is the second occurrence of a descending top flat bottom, a compression triangle, which is a way to define a correction. There's two basic groups that they come in, although there is a lot of nuances to those groups. But what we call a simple zigzag means that it goes from $1 to $1.50, down to $1.25, and then to $1.75. In other words, you get a zigzag like you get from this low to what I'm labeling as 1 to the conclusion of the correction. The other way is you get a series of typically lower highs and higher lows. In other words, you have a triangle on both sides. So what we're looking at is we now have what I'm labeling as a wave one on our Elliott wave count after finishing a correction, with the conclusion of the fifth wave occurring back on Friday, the 17th of May. And that's when it hit the second of new all-time record highs. It then would correct over a period of a couple of months. It broke out, and that was the last time we talked. It definitely found resistance. It's come down the remainder of the week by 50%. If it holds here, that's one thing. If gold continues to trade under pressure at the beginning of next week, I don't think it would have far to go. As I said, my target would be around 2375. That's a 61.8% retracement of the rally up. And from there, you go into a third wave. Basically, an Elliott wave, it is based upon a 8-wave cycle, of which the first 5 waves are what's called the motive phase, which will typically include, on a bullish count, 3 waves that are strong rallies, in other words, price gains. In between them, wave 2 and 4 will be the corrective wave. So you get wave 1, wave 2, wave 1, wave 2, wave 3, wave 4, and wave 5. So this model is taking a lot of flexibility inherently as we get out in time. Gold does find support either at current pricing, right at around 2,400, or a little deeper to 2,375. It would move at least equivalent to what we saw during what we're labeling as the first part of this rally, or wave one. In other words, from 24, we would move back to about 2580 or 88. A really bullish rally would take it to 26, and as high as just shy of 2,700. And this model is a long-term model. I wouldn't expect it to reach any of those peaks till the end of this year, first quarter of next year. Gold, the precious metals to us are paired against dollars. As long as the government creates a larger debt, in other words, the fiscal deficit continues to widen, we have more debt, it can't support the dollar. The dollar is going to lose value against the currencies that it's weighted against. In the case of the dollar index, what we're discussing, that's what has been really moving the dollar lower from recent highs at around 106 to just below 103, a 3% drop in a short period of time. So that is a very large factor of why gold has had a stellar performance.
During the interview, GaryWagner underscored a compression triangle indicating the potential for a bullish breakout, which occurred but was followed by a correction. Gold is approaching its record highs, rising 50% from its 2022 lows and 25% since mid-February. According to Morgan Stanley commodity strategists, this surge is driven primarily by the physical market, with central bank purchases doubling in 2022 and 2023 compared to previous trends. Retail buying has also increased this year, especially in China, where bar and coin demand is very strong. Moreover, Wagner reflects on recent market events, particularly Federal Reserve Chairman Powell's indication that a rate cut could occur before inflation hits 2%, marking the first rate cut since their previous hikes. Consequently, Wagner notes this as a pivotal moment influencing recent movements in gold, which reached around $2,500 before retracing. Let's get back to the interview.
What we are witnessing now was when you consider that the low that came in on this compression triangle or descending top flat bottom was from 2,300 to 2,488. So we're talking about a move of roughly $188. That's a respectable rally for gold. That, coupled with the fact that it hit a very strong, even psychological number, 2,500, it found resistance there. And the absolute top of the market occurred a couple of days ago, but that was also the day that gold futures traded to the highest intraday value in history, which is 2,488. So what we witnessed through the week has been, I believe, profit taking, and it is a correction. So the question is, will this be a shallow or deep correction? Because what you see in blue to the right of these lines are based on a Fibonacci retracement or a retracement set. So we start at 2,308, we go up to 2,488, and a 50% retracement. In other words, if it gave back 50% of the rise, that would have taken it to about 2,400. And that's kind of where we're at, because we're at 2,401. So the question is, will it find support at this level? If not, it most likely will trade lower to the 50-day simple moving average, which also corresponds to the 61.8% fib retracement at approximately 2375. When we look back to what occurred on Monday, that really was that last feather in the cap of the rally. Powell came out talking at the Economic Club of Washington. When asked about a September rate cut, in fact, any Fed member, when asked about the timing of a rate cut, would simply push that off. Powell's language was that we're focusing on getting inflation down to a 2% target. We're not there yet, and we need greater confidence, always put in quotation marks, and that greater confidence comes from more data, which simply means more reports lending evidence to the fact that inflation continues to tick down. Now, prior to him speaking, the last inflation report that came out showed a consistent trend of 3 months, consecutive 3 months with lower inflation prints. And so for the first time when asked about a September rate cut, he said, I'm not going to address the timing, but we will cut rates before they hit the 2%, before inflation hits its 2% target. And so in Powell speak, in Fed speak, that's a clear indication that they most likely they're planning on initiating the first rate cut since they started raising rates in March of 2022 and beginning a process of interest rate normalization. In other words, it's the first rate cut is exceedingly important, but then we have to go back to the dot plot. The most recent one is in June, and the most recent dot plot, which takes the 19 members that are at the meeting and has them vote on the likelihood of where inflation will go, where interest rates will be, and what the GDP of the economy is. And in March, they were anticipating that they would cut rates 3 times by 0.25%. In June, they revised that to 2 times by 0.25%. So the fact that he opened the door to a September rate cut is really what created the last moves in gold, and it found resistance at 2,500. Anytime any stock or commodity goes to an all-time record high, it typically meets resistance, backs off, even if it's still in a bullish momentum. And that's what we're seeing with gold.
Historically, investors have flocked to gold during turbulent economic phases as a hedge against inflation and devaluation of fiat currencies. The present scenario aligns with past trends, illustrating gold's compelling narrative as a safe haven. Gold set multiple record highs in 2024, further underscoring its potential to outpace inflation and preserve purchasing power. Will gold continue its upward momentum, or are we poised for a correction amidst shifting economic landscapes? What factors will most influence gold's path in the months ahead? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.